go to newsnationnow.com.
12:10 on WGN. I want to officially welcome you to Friday afternoon. Ooh, that feels nice, doesn't it? On a summer Friday. Ooh, we can see the finish line up ahead. Before we get there, though, we got a couple things to take care of. And helping us out to start the winter's business lunch, our good friend Craig Bolanos, co-founder, wealth advisor at VestGen Wealth Partners. Craig, I knew there'd be a time we get to chat during the daytime instead of the nighttime. Glad it's today.
You know what? I'm glad it's today as well. What an interesting market cycle. Political appointees get fired, got a new person in at the Fed. We'll have to see where we go, but so far complacency is the rule of the norm.
I got to ask you, this week we've had a few guests on kind of doing a vibe check of this economy, and to say subpar would be kind of what people are feeling, a sense of worry perhaps. Yet this market, which you always remind us, is forward-looking. There's been some down days, but we're looking at gains on the week again. Is the market missing something? Are the other guests missing something, or is it just too hard to tell?
You know what? It's a little bit of both, right? I mean, I know I'm hedging my answer with you, John, but the truth is, yes, we need all this worry because it's the human psychology. Markets climb a wall of worry. Hence, new highs make new highs. If everybody was euphoric and if everyone believed in the soft landing, no landing, guess what? This bull market would be over and equities would be cascading to the downside. So I think there's reasons to be concerned about the increases in bankruptcy. There's reasons to be worried about negative auto equity that you and I have talked about on your programs. There's reasons that jobs print, which was more than soft, is scaring everybody and reminding us that we're not out of the woods and stagflation is a threat. But when you look at earnings, and ultimately stocks are forward-looking, it's about earnings and profits in the future, this story still remains intact.
I read an interesting paper earlier this week. I can't remember the author. I'll try and find it before the end of the show today. Just talking about how the length of bear sessions have gotten rather short, meaning we've had corrections, we've had bear markets over the last 15 or 20 years, but we haven't had a really long one since kind of the lost decade that led out of the Great Recession and a few years after that. Does that give you any pause, or do you feel like, hey, quick corrections and quick bear markets are still downward trends for a little bit to correct the prices a bit?
Well, you know, I wrote a piece the other day called Volatility's Vanishing Act, and I think it's related to what you're saying, John. I mean, we had this historic surge in VIX, Vol, around the April 2nd tariff announcement, and subsequently, markets, they've undergone a dramatic reset. In fact, I would argue that over the past few months, volatility hasn't just declined, it pretty much all but collapsed. And that widespread decline in volatility is so notable because it tends to be mean reversion to the mean. What do I mean by that? It's a play on words. Periods of extreme calm are oftentimes followed by sharp reversals and vice versa. So no, we're set up for some air pockets into the seasonably weak period of August and September. You know that, I know that, but dips are normal in markets, and it's going to be an opportunity for investors to rebalance their portfolios, or those who are on the sideline to start attracting some of that cash, because you can't hang out in high-yield money markets forever, guys. Rates are going down one way or the other.
And I like that you call them air pockets. The impression that I get from that is the plane still flies. The bumps are there, but you're going to land the plane at some point and be okay.
That's exactly it. That's right. So it's not time to don your, safety belts and assume those crash positions. I don't think that's the case at all. Okay. But it is time for vigilance. I think that is so important. And we have to be paying attention to the future. And part of the future is how do stocks perform during Fed easing cycles? I mean, that's where we are, and that's where we're headed. So I think that's what people should be focused on.
All right. We're not done yet with Craig Bolanos, co-founder, wealth advisor at VestGen Wealth Partners. GetRetiredStayRetired.com to start your journey to have more conversations one-on-one with Craig and his team there. And at 12:15, let's get a look at weather. The markets, too. Mr. Kessler, how are we doing?
We are seeing the Dow
at 1, which you'll hear me on. Okay. Craig Bolanos, VestGen Wealth Partners, get retired, stay retired. All right, Craig, I saw that the president has nominated someone to the Federal Reserve Board. There was a lot of bluster about whether he'd fire Jerome Powell. You and I chatted that there's no chance, really no chance, that he was going to do that. But he can still shape the future of the Fed through these nominations, right?
Well, we can. I mean, listen, when certain Fed board members retire prior to their term coming to an end, you get the chance to appoint. And he went ahead and did that today. So, President Trump went ahead and did a nomination. That just means we have one more voting member of the Federal Reserve who is inclined to be dovish and lower rates. We're clearly going to let JP, who I affectionately refer to as Jerome Powell, we're going to let him continue his term into next spring, but then it's all but guaranteed that we're going to appoint someone who has a more dovish bent. So the bottom line is rate cuts are coming, but rate cuts are no longer the most important element. I mean, John, I've lived through literally 3 markets inside of 8 months, and right now, people, they're no longer paying as much attention to taco, right? Trump always chickens out. Everyone's going to be solely focused on what I call economic growth. That's probably where it always should have been. That's squarely where we are. So it's economic growth, followed by rate cuts, followed by trade. That is the soup du jour for people who are actively navigating this equity market.
I mean, we want a Fed with different viewpoints on it, right? Like, I mean, it's supposed to be this independent body. I don't think there is anything wrong with having hawks and doves sit in a room together and make decisions.
No, that's how great leadership and great governance comes from. It comes from the art of conversation that's rooted in a common bond of maximizing unemployment and maintaining stable prices. That's what you want to see. And I think we're still going to have this because at the end of the day, the Fed makes their decisions not because of political appointees. The Fed makes their decisions through a very data-dependent, data-driven process. And for all of us, we get frustrated because sometimes we want the Fed to be forward-looking, but we have to respect the fact that the Fed is data-driven, which sometimes means they're a little bit late to the party, right? They're a little bit, whatever it might be, late in leaving the party, and that makes them seem more reactionary, but that's where they should be because it leads to the consistency of results over decades, and I don't think we're straying from that.
It's the worst kind of party guest. They come late and they leave late? No. When I say 6 to 10, I really mean 9:30, to be perfectly frank with you, Craig Bolanos. That's when I assume people would leave. You mentioned that taco isn't really the thing anymore. Trump always chickens out. I think I agree with you. I think part of the reason why is because how many deadlines have we seen come, go, change with different countries that it's almost, as a layperson, hard to keep track of where tariffs are and where they're supposed to go next according to deadlines set. Some might look at that and say that's a chaotic way to govern. Others might say, well, that muddies up the whole thing to the point that the markets can't pin certain days to be pitfalls or triumphs. That almost this never-ending cycle of different negotiations leads to a situation where it gets ignored on the whole. Do you feel that that might be part of the case?
Oh, I do. And the taco trade was very, very real. It was a good Tuesday. It was tasty when it first started. But now it just has much less importance because taco's been proven at least partially false. I mean, with all the reciprocal tariffs that have been announced and all the trade deals that have been struck with major trading partners, the reality is the consensus, groupthink, Wall Street, everyone expects aggregate tariff rates to settle between 15 to 20%, which is solidly higher than the previous expectation of 10 to 15. And that increases the risk of stagflation, but also will provide some semblance of stability in trade going forward because at least we know where we're settling.
Yeah, I do think that the taco has lessened. Imagine having this conversation a year ago. People are like, what are you talking about? But I do think the ultimate taco is still there. Sorry, let me explain myself. Craig, I think that you're right in that these back-and-forth negotiations, we've had some wins the Trump administration would say on some of these negotiations for maybe not much of a political give-up that he's been able, especially the EU. But I still think looming over all of this is that the president is beholden to the midterm election of next year, meaning if treasuries start going up while stock markets go down like they did for a time in March, there still is a release valve that the president will take. And I think that still guides the market on a generally favorable course because they know that if whatever you say hits the fan, you know what I'm saying, that the president still does have a limit here.
Well, isn't that wonderful? Listen, in this society, in this divine experiment that started so long ago, we have a series of checks and balances. Some of those checks and balances are rooted in the Constitution. Other checks and balances are simply rooted in the common sense of math, which is a free market society, right? And you just mentioned, treasuries. And one of the things I talk about with everybody is if there's a phenomenon, a single phenomenon that's been incredibly consistent all of 2025, John, it's that the steepening yield curve is here, right? Short-term rates are continuing to go down. Intermediate to longer-term rates are trending higher. That's very important. Because
Explain why that matters. Explain why that matters.
Well, I think it matters for a whole lot of reasons. I mean, when I look at the steepening yield curve, which is a return to normal, we're no longer in bizarro world. What we have is 2-year rates dropping below what they used to be, and we're going to continue to have longer-term rates be higher than short-term rates. And here's the implication. It just means this market's going to broaden out. I mean, when I think about who benefits from a steepening yield curve, John, it's banks, because they borrow from the government on the short side and then they loan it out intermediate to long term. When I think of a steepening yield curve, I think about winners like utilities and real estate. Those are two sectors that are essentially bond proxies, but as long as the curve is steepened, they're going to stay in play. And dare I say, the part of the stock market that's been unloved and no one wants to touch, it's like an ugly duckling, which is the S&P 600 or Russell 2000 small cap stocks. The time is not now, but if we can get these short-term rates to continue to come down while longer-term rates expand, that's going to put a tailwind behind the borrowing costs of all these small companies over the United States, which can allow the soft landing and narrative to continue. So everyone says the bond market is the smart money. It's a system of checks and balances. I would argue that's what gave us the pivot from what was the April lows that we had earlier this year, and we changed on trade. But if you follow that data, you follow that trend, it gives you an idea as how you too can diversify your diversifiers.
I got to go, but I just want to make sure everyone understands this, and me important as well. The 2-year going down and the 10-year going up means the 2-year, more people want the Treasury bill for the 2-year, which drives the price lower, supply and demand. Less people want the 10-year, which means that price goes up. And that phenomenon of being able and wanting and okay with locking your money up for the short term but not the long term signals economic health because people want more money on the sidelines to play in the markets and other places. Am I getting that right?
John, that is why you are the news anchor, and I am but a guest serving at your willingness. Yes, you said it in a great soliloquy for everyone to digest.
I didn't know going into it whether I was right or wrong, so please don't call me the news anchor. But Craig Bolanos, is always good to talk with you. GetRetiredStayRetired.com. Talk soon.
Thanks, John.
Real news anchor comes up after this break on WGN.
Ain't nothing gonna break my